Are you consistently getting returns as high as my subscriber count? Are you reading financial reports like reading the terms of service? Then stop watching, this video is not for you. There are basically two ways to find a good stock for investing your life savings. Option number 1, read all 640 pages of your favorite investing book, and then start screening for viable stocks. And option number 2, go straight to TikTok baby.
Breaking news, another Russian jet was intercepted in Alaska today. So, if you think World War III is coming, then I would definitely add some of these stocks to your watch list.
I'm investing $50,000 into this penny stock. Hear me out, it's a small but growing fast food chain that's focused on making healthy food. They went public as of last year, and just as of last month, they posted a 228% revenue increase in their second quarter filing.
But wait, there's another way. What if I told you there's a better way to screen for stocks, that is both more elegant and scientifically superior to the other rookie methods? A method that requires even fewer IQ points to execute than following a TikToker's stock signals, a method that manages to screen for stocks without actually screening for stocks. I present the Random Stock Generator. Looks like we're gonna analyze Canada Goose today. I like to start off by gaining some basic knowledge about the company first.
Good.
Let's check out the website. The products look nice, but damn, those prices are as high as the price for the Finance Guru's course from the ad you saw before this video. Just from looking at the stock, it seems like there's some potential. We're currently trading at $15 and the 52-week high is at $25. The aim of the game now is to sift through all the information on the website to try to understand the business as much as possible. So what I've gathered from carefully and thoroughly skimming through the financial reports, is that Canada Goose is a lifestyle brand and manufacturer of performance luxury apparel. Their main sales channels are through retail stores and their e-commerce store. Their products are sold in 57 different countries, mainly in, well, Canada. They have a high degree of vertical integration and the target audience of Canada Goose is Gen Z. Let's look at the company's vision for the future. To make this step suck slightly less, imagine yourself in the role of a shark at Shark Tank and the CEO of Canada Goose is pitching its company to you. But since on this channel we like to pollute the 90% of unused brain tissue with unfiltered Investors Day presentations, we will accept the risk of severe cognitive impairments and take a painful but necessary glance at the financial presentations. Here's a step-by-step summary of Canada Goose's 5-year strategy. Step 1. Prevent the retail stores from gobbling up our Canadian dollars. Canada Goose plans to achieve that by cutting off the middlemen and focusing on direct-to-consumer marketing. Step 2. Success. Now we don't sell any products anymore.
Back where you fucking started, Wagey.
Step 3. Double our own stores and improve our direct-to-consumer experience. Step 4. Offer second-hand products for the financially challenged. This will get them hooked to the brand. Step 5. Offer products at duty-free shops at airports to magically make high prices even higher. Step 5.1. Then make higher prices even higher by focusing on women. And Step 6. Let's look at some numbers first. More specifically, ratios. Let's check out our liquidity ratios. Why? So we don't run into liquidity issues like the last time you tried to cash out your FTX meme coins. They essentially tell us how easy it is for our company to pay its bills. But don't make the rookie mistake of confusing liquidity with profitability. They are different. A company can be both highly profitable and out of cash at the same time. For example, when a company experiences rapid growth, we basically have two choices here: current ratio and quick ratio. For the current ratio, we divide our current assets by our current liabilities, and for a quick ratio, we just take our cash and receivables and divide it by our current liabilities. We disregard our inventories. This makes the quick ratio a far more conservative measurement. Think of it like this: these right here are the 10 remaining unscathed dollars sitting in your Robinhood account right now, your cash, plus receivables, and on the other side you have your $10 a month Netflix subscription, which leaves you with a quick ratio of 1. Firstly, a quick ratio of 1 strongly indicates that
You're broke! You're fucking poor!
And secondly, it translates into you having to use all your cash to pay off short-term liabilities. Now, which of these liquidity ratios makes more sense to use for Canada Goose? If your answer was current ratio, then you should consider emailing your resume to Berkshire Hathaway. The quick ratio is more conservative because it leaves out the inventory. But these are retail clothing brands we are talking about. It's way easier to sell these $75 Canada Goose socks than it is to sell this $20 million plain engine. Plus, the receivables are gonna be low too because people tend to pay for clothing right away. This means that our quick ratio is gonna be atrociously low even though we might be very liquid. So let's take the current assets and divide them by the current liabilities of Canada Goose to calculate the current ratio, and when I say calculate, I mean just look it up instead. 2.15 especially when compared to our competition is pretty liquid. While our current ratio has been decreasing slightly over time, it's still nothing to worry about. Next step, profitability ratios. Let's see if Canada Goose is as profitable as the average Wall Street bets options trade. Our 12.88% return on equity is around our peer average, but it's decreasing slightly over time. Let's investigate. Pro tip: always convert your balance sheet and income statement into common-size statements. This makes it easier to compare our numbers on a year-to-year basis and to our competition. Our total revenue has been increasing slightly and our cost of revenue has actually gone down. But, our operating costs, more specifically selling general and administrative costs, have increased over the last 4 years from 37% to 56% of our revenue. This could be explained by higher marketing and advertising expenses. Next step, let's take a moment to look at the cash flow statement. Next. Very important question. Would you buy this $1,300 jacket for your next Thailand summer vacation? If we take a look at our Google Trends, what do we notice here? We notice something very profound, that people tend to buy winter clothes in winter. Does that mean our stock is cyclical too? From looking at that stock, it doesn't seem like it. Let's analyze if our current stock price of $15 is fairly priced. For that, we are going to calculate and compare our PE ratio to that of our competitors. To calculate the PE ratio, we divide our share price by earnings per share. What do we mean when we say calculate? Exactly. We look it up on Yahoo Finance instead. Trailing 12 months, we are at 42 right now. What does that tell us? Not much actually. We need to compare it to our competition. Comparing our price to earnings ratio with our competitors will help us determine if the Canada Goose share price is overvalued relative to our industry peers' average. Our PE ratio of 42 is pretty much at our peer average. This could imply that our stock price of $15.45 is fairly priced. And finally, no stock analysis is complete without sprinkling in some illegal insider trading.
Actually, I'm just kidding.
High-ranking officers and directors are required by law to make their trades public. You can check them out on Dataroma. Typically, stocks are sold for many different reasons, but when the directors buy, it suggests that they think that the stock will go up. Which is a useless piece of information, because we already know.
Stocks go high, and then they go higher. Stocks only go up.
In the past 3 months there were only sales, however, no buys. Now, let's spend a few seconds to take in our analysis. While I like some parts of the strategy, like expanding into all-season products, targeting Gen Z, and bringing the brand to Europe, I'm not sure travel retail and second-hand are the way to go. But let's see, since travel retail is a growing market, the company numbers seem healthy. The Goose's liquidity and profitability are fine. Not exceptional, but not bad. And finally, the current stock price doesn't seem too far off from the intrinsic value. The stock price is probably slightly undervalued, but making a valuation is definitely a bit of a fugazi. But if their forecast of tripling the revenue in 5 years turns out to be true, which it won't, then assuming our PE ratio stays the same, which it won't, our stock price would triple too.